Hello and welcome to Crossing the 49th, a cross-border tax and financial planning podcast. I'm your host, Phil Hogan, and today we're going to talk about common mistakes I see with expat and cross-border tax returns. Okay, today we're going to talk about some common mistakes I see with cross-border tax returns. So this will be from the context of Americans living in Canada, and we're not going to talk about entry returns or exit returns, but we're going to walk through some of the more common mistakes I see either when I see individuals prepare their own tax returns or from other professionals. And once again, this is not to point out anybody's mistakes. It's really just informational. And for those really that do their own cross-border returns, this should be helpful because this is really like the top. I think there's 14 or 13 things here that I see on cross-border returns. So if you're doing your own returns, this would be a great podcast to bookmark and take a read through the article that I wrote on the subject. So we'll do the podcast today, but there's also an article that I'll link in the YouTube and the podcast description that outlines these items in more detail. Okay, so let's start with the first one. So, and these aren't in really any particular order. They're just really just the most common things I see on cross-border returns. So number one, incorrect calculation of foreign tax credits. So as we all know, we're filing our worldwide income on both our Canadian and our US return. And if we weren't going to calculate any foreign tax credits on either of the returns, then essentially we'd be paying double tax. So we'd either pay tax to Canada and the US at the same time on the same amount of income. So this is where I see a lot of errors, where your Canadian foreign tax credit's incorrect or your US foreign tax credit's incorrect. And in a lot of cases, you're really either overstating or understating your foreign tax credit on each side of the border. So you're either overpaying or underpaying. And honestly, in practice, you're probably not going to see a lot of reviews and questions from the IRS on foreign tax credits. So that would be Form 1116. Although we do see that sometimes. You're going to get most of the questions from CRA. So we get a lot of foreign tax credit reviews at the office for calculation of foreign tax credits for Americans living in Canada. So a good example is you might have a client that has a pension in the US and they receive pension income. It'll be taxed in Canada. It'll be taxed in the US. And essentially you'll get a credit for all the taxes you paid to the US on your US tax return. Now, if that calculation is done incorrectly, they're going to review it and they'll either kick out the amount that they think was overstated, which is almost always the case. You might also have foreign tax credits on your U.S. source wages, your U.S. source dividends. So just know that when you're doing your Canadian return and your U.S. return together, those foreign tax credits are really important to calculate properly. Because once again, likely won't hear from the IRS unless the amounts are terribly incorrect. Or very large, but you certainly, in a lot of cases, will hear from CRA, and what will happen, you'll file the return. It'll either go through post or pre-assessment, and they'll send you a letter asking you to verify the amounts that you claimed as foreign tax credit, especially if they're large. Okay, so let's move on to number two, taxing U.S. Social Security on U.S. returns. I see this a lot. For those that are not familiar, for those that are resident in Canada, Americans resident in Canada, or just individuals in general, because you don't have to be American, U.S. citizen or green card holder to receive Social Security, you're not required to report your Social Security on your U.S. return, which is odd. I mean, it doesn't seem to make sense to a lot of people, and that's because you wouldn't think that you wouldn't have to report your Social Security on your 1040 return, but pursuant to the treaty, you're only taxable on your Social Security income in the country where you're resident. So if you're a U.S. citizen living in Canada, you're only taxable on your Social Security in Canada. And that would be the same for CPP and OAS. So you're only taxable on OAS, CPP, and Social Security on your Canadian return. So we see this error a lot where individuals are claiming their Social Security income on their US return and then claiming a foreign tax credit in Canada. Now, if that got reviewed by CRA, that'd get kicked out because it's incorrect. Don't forget that when you do exclude your Social Security from your U.S. return, you want to make sure to include that treaty election form, the 8833, so that you can actually exclude Social Security. So once again, tax residents of Canada will not be taxable on their Social Security in the U.S., only in Canada. And then you also get the 15% deduction in Canada for your Social Security. Okay, what's the next? So the next one is filing of FBARs and 8938s. So most Americans living in Canada are very familiar with FBARs. So to the extent that you have foreign financial assets, so foreign to the US, You'll have to file an FBAR. You'll also have to file an 88 or 8938, which is really similar to the FBAR in that it's all the information contained, or most of the information contained in the FBAR is actually in the 8938, and that gets filed with the 1040 return, where the FBAR actually gets filed with the Treasury Department. So once again, we review lots of U.S. returns, and often, we'll review the U.S. return. The U.S. return might seem correct. However, when we ask the question, have you filed FBARs? A lot of times we get answers, what's an FBAR? So if you're filing your own U.S. returns, make sure that you also are filing FBAR returns. And you can go to the blog. There's many blog posts on what an FBAR is and how to file it. But essentially, if you have more than an aggregate of $10,000 in non-U.S. bank and financial accounts, then you'll need to file an FBAR with the Treasury Department. Okay, what do we have next? Okay, so the T1135. I write a lot about the T1135 on the website and the blog. So essentially, if you, for Canadian tax residents, if you have non-Canadian investment or bank accounts with a cost base of more than $100,000, then you'll be required to file this T1135 form. And we see this likely more often, or we see this more often not filed compared to FBARs. So if you're filing your own Canadian cross-border returns, so you're a U.S. citizen living in Canada, or if you're not a U.S. citizen living and you have foreign assets, remember that T1135 is really important. There's actually a question on page 2 of the Canadian return that asks you, do you have any foreign financial accounts? And then there's a yes or no box to that. And that's really kind of just to tag you in to make sure that you know to do that 1135. Because the penalty on that form, unlike a tax return where if you don't have tax owing, you might not have any penalties. The penalty on that form for late filing is $25 a day to a maximum of 100 days. But when somebody misses that form, they don't miss it for 2 or 3 days. They often miss it for the whole 100 days, which is $2,500 plus interest. So, and once again, you miss that for multiple years, and interest accrues on that and starts to compound. So if you have late 1135s, and we've wrote about this a lot, make sure to contact somebody that has experience in filing these, likely under the voluntary disclosure program, because if you send them all in and they all get penalized, it's going to be very difficult to get the penalties abated. I mean, really your only option at that point is to go through taxpayer relief, and that's a really difficult program to get penalty relief through unless you have a reason like natural disaster or a health issue. It's very, very difficult. So make sure to file your 1135s on time. Okay, so the next one is not reporting 100% of your worldwide income on both your Canadian and your U.S. tax returns. So we see this a lot where Americans might move to Canada and they start filing their cross-border returns, and they report their U.S. source income on their U.S. return, and they report their Canadian source income on their Canadian return, and they file both the returns. The problem with this is both as an American citizen and a Canadian tax resident, you're required to report your worldwide income to both CRA and the IRS. And in order to not pay double tax on that income, what you end up doing is using foreign tax credits to make sure that you pay the right amount of tax, which is really just not double tax under the treaty. But certainly you need to report 100% of your income on both returns. So once again, we see this a lot. So when you're filing your returns, make sure that 100% of your income is filed on both the Canadian and the U.S. return. Okay, next one, not properly calculating cross-border capital gains. So once again, this is very common. What you'll see often is, you might have 20 transactions, 30 transactions of proceeds or sales in the year. So you've sold 20 stocks or whatever securities you might be selling. And let's say you're Canadian, and let's say these are all Canadian stocks. You have $100,000 Canadian capital gain once you calculate the difference between your proceeds and your costs. Now, for U.S. purposes, the gain in the U.S. is not necessarily 100,000 times the exchange rate, or divided by the exchange rate. So let's say the exchange rate's 1.25. It's not $100,000 divided by 1.25 to get your U.S. gain. What you have to do is you actually have to calculate the foreign exchange rate at the time of purchase and the time of sale to properly calculate your Canadian or your U.S. capital gain, and vice versa if you have U.S. stocks. And that's important because the exchange rate can in the U.S., as everybody knows, fluctuates throughout the year and throughout many years. So when you actually hold stocks for a long period of time, not only do you have to calculate the appreciation in the security, but you actually have to calculate the increase or decrease in the actual exchange rate. So when you're calculating capital gains for cross-border purposes, you have to calculate the cost base, the exchange rate at the cost base level, and then at the proceed level as well. We're not going to get into detail how to do that. Just know that you're not just applying an average rate to your capital gains when you're calculating. And we see this a lot. Okay, the next one, not properly extending your US returns. So we just did another podcast on deadlines that will be posted soon. But just remember, if you feel like you're not going to be able to file your Canadian or your US tax return on time, make sure to extend the return. So for Americans living in Canada, we have both, we have an extension, an automatic extension to June 15th. So that's really helpful. If you file an extension before June 15th, you will then, with Form 4868, you'll get an extension to October 15th. And if for some reason you still don't have the information required to file your return, you can request a further extension to December 15th. But that's, I would always suggest just filing your return by October 15th if you can. But if you really get stuck, you can write to the IRS, and I've posted this in one of the blog posts on how to do this. You write a letter to the IRS explaining why you need to extend further to December 15th. You won't receive a reply from the IRS unless you're actually denied the request. So once again, make sure you file your US extensions if you're not going to file by June 15th if you're living in Canada or living outside of the US. And once again, I wouldn't even wait till the last minute. Like if you feel like you're going to need that extension, just file it so that it's in. Now for Canadian purposes, we actually don't have a prescribed way to extend a return. So we know that self-employed individuals get to June 15th to file their Canadian return. So that's helpful. However, everybody else has till April 30th. So now, once again, the advice is always file your tax returns on time. But if for some reason you get stuck and you can't file your Canadian return by April 30th, make sure first to pay the amount of tax owing, because there'll certainly be a penalty if there's any tax owing at that particular time. And then any information returns that you have, like T1135s or T1142s, make sure you file those, because if not, those will be late and then they'll accrue the $25 a day penalty. So once again, really important to extend your returns and pay taxes if for some reason you feel like you can't file on time, which you almost always want to file on time. And then if you have to adjust later, that's fine too. Here's a small one on the 1040 return on Schedule B, where you list out your investment income. There are questions at the bottom. So there's questions about, do you have foreign financial assets, foreign to the US? And if so, are you filing FBARs? And then there's a question about 3520s, if you receive distributions from estates, or if you've provided gifts, or if you've received gifts from a non-resident. Those questions need to be answered on Schedule B. A lot of times when we review cross-border tax returns, we see those questions are not answered. Very important questions to answer on the 1040. Okay, so the next one is paying SC tax on business income. So for U.S. persons, so if you were a U.S. person, domestic resident in the U.S., you would pay SC tax, which is self-employment tax, on your business income, which is very similar to the CPP premiums we pay on business income up here. But for residents of Canada, so under the agreements between Canada and the U.S., you're only subject to Social Security taxes on your business income in the country of residence. So when you file your U.S. return, so here's an example. Let's say you're a sole proprietor, you earn $100,000 of business income. That gets reported on your U.S. return. That gets reported on your Canadian return, and most likely it's Canadian source income. So you'll get a credit in the U.S. for any Canadian tax you pay. But also, if you don't properly exempt yourself from the SC tax, you'll pay a level of SC tax in the U.S., but you'll also be paying CPP premiums on that business income. So make sure that if you're American and living in Canada, that you have business income, that you're not subject to SC tax. And depending on the software that you use, you'll have to find a way to exclude that amount, and you have to put proper disclosures in the return as well, to make sure that the IRS knows why you're not paying that SC tax. That's one thing we see a lot with reviews. If you don't put proper disclosures in the return, they don't know why you're excluding certain amounts. Okay, so next we have using the wrong exchange rate for the income or capital gains, or even FBAR rates that you're using. So rule of thumb here, and this is not necessarily always the case, but income is going to be converted at the average rate. So we have, and I posted this, I have all the average rates and the year-end rates that are prescribed by CRA and the IRS. So any income you earned, so when you convert from Canadian to US and from US to Canadian for each respective return, income is going to be reported and converted at the average rate. You're going to calculate capital gains based on historical. So you're going to calculate your cost base based on historical purchases and the rates at that time, and then the proceeds at that particular date. And then for FBARs, they want you to use the actual year-end rate instead of the average rate. So just be conscious when you're actually doing these calculations and these conversions that you're using the appropriate rate, because we see that done incorrectly quite a bit. Okay, so this one is a lot less common, but really important. So not filing a Form 5471 if you're the owner of a Canadian corporation. So just to keep this short, if you have ownership in a private company, a non-US private company, which is often just a Canadian corporation, you're required to file this 5471 on your 1040 return. Now, the 5471 is a terribly complex form. The rules around the 5471, I mean, we could spend hours just on that. But just know, if you have ownership in a Canadian private corporation, really any non-US private corporation, that 5471 form is really important, because that form has a $10,000 penalty, and we do see that penalty. Unlike FBAR penalties, when clients might file their FBARs late, we tend not to see them being penalized. That's probably a factor of being in Canada and recognizing that our tax rates are higher and nobody's necessarily hiding assets. But if clients are filing those, or newer clients had not filed those on time, we're not seeing penalties from the IRS, but certainly for late 5471 filings, we are seeing penalties. So make sure, well, first, to file that form on time if you need to prepare it. And if you haven't filed that form, then make sure to reach out to somebody that has experience in this, because if you just start filing that form late, they certainly will charge you $10,000 per late form, which of course is a ridiculous amount. I think the reason that amount is so high is because they tend not to differentiate between large multinational companies that have these late filing penalties applied to them if they actually file these forms late, and individuals. And they really need to fix this. It's not fixed right now, but just know that if that form is filed late, $10,000 penalty. So we're really hopeful that they'll change these rules, because it's certainly not fair to those that have missed a form without knowing. But when in doubt, obviously contact somebody that has experience in this, and then file that form on time. Okay, so next we have incorrect reporting of K1 forms for Canadian purposes. So lots of clients receive K1 forms, so they might have interest in US partnerships, they might have distributions from an estate, they might have distributions from an LLC. So what you want to know about receiving a K1 and reporting it for Canadian purposes, what you'll find is if you're familiar with K1s and you look at just a regular K1 that you might receive, it'll show distributions for or allocations rather for capital gains, for interest, sale of property and special rental income in the US. You don't necessarily get the same treatment on the US side than you do in Canada. And I always use the example of, if you have distributions from a US estate, and they might allocate out capital gains and even exempt interest, and then or business income or any other types of income. For Canadian purposes, distributions from a US or foreign estate is simply just income. So you might receive $100,000 from your foreign estate or foreign trust, and it might include capital gains. You're not reporting those capital gains on the Canadian returns as capital gains. 100% of the amount is income, but for US purposes, it actually might be capital gains. So this gets really tricky. And if you have lots of K1 forms, you certainly want to get somebody that knows what they're doing, because the income on the K1 does not retain its character for Canadian purposes. So just the takeaway here is, if you have K1s with significant amounts of income, get some advice and some help on how to report this for Canadian purposes. Because certainly if CRA looks at the return and they have questions, they'll reverse a lot of these amounts, especially if you're claiming capital gains from a US estate when it should have been full income. Okay, so what do we have next? Incorrect sourcing of W-2 income. So we see this a lot where we have Americans living in Canada that actually still might be working for US employers. Now, technically speaking, if you're a Canadian resident working in Canada for a US employer, especially if you're living here and this is not a temporary move, the company should actually be paying you on Canadian payroll and issuing you a T4 slip. So you should just be paid on Canadian payroll. It shouldn't be any U.S. withholding or FICA tax or Medicare tax via W-2. The problem is a lot of companies, especially if they're smaller companies, don't have payroll set up for Canadians. They don't have a Canadian arm. So a lot of our Canadian clients are paid on W-2, which means those wages are actually Canadian sourced. So when we prepare the return, most of the tax goes to the Canadian government because that's Canadian source wages, not U.S. source wages, which makes it really tricky because we have withholdings on the U.S. side that we have to get credit for in the U.S. So it gets really complicated really quickly. So just know if you're preparing your own returns, or if somebody's preparing your returns for you and they're classifying W-2 wages as U.S. source just because they're on a W-2, if you're a Canadian working in Canada, that's likely incorrect. So just a red flag. Make sure if you have that issue to reach out to somebody. Okay, so the last one here before we wrap up, filing of a 1040 NR instead of a 1040. So, once again, we see this a lot where this is often, American moving to Canada, they start doing their own returns. I just had one of these the other day, an inquiry that came to my email. He was filing, ever since he moved to Canada, he's filing 1040 NRs even though he's an American. So it might seem like that makes sense where, move to Canada, I only file my 1040 NR on my U.S. source income. But as we know, U.S. citizens living abroad or of course living domestically in the U.S. are required to report their worldwide income on their 1040 return. So if you're an American citizen or a green card holder, you're going to file a 1040 return every year. So if you're not, then perhaps you have a 1040 NR for rental income or business income or what you might be earning down there. But if you're a U.S. citizen or green card holder, a full 1040 with 100% of your income on your 1040, 100% of your income on your Canadian return. Okay, so we got through quite a few there. Obviously, there's more. And if you're watching this on YouTube, I'd love to hear your questions or comments below. I do my best to answer every question that gets added to the page. Don't hesitate to reach out. All my contact info is below, phil@philhogan.com if you have questions. Would love to hear some feedback on what everybody would like to see for the next couple of podcasts. And yeah, thanks again for watching. Don't forget to subscribe to the channel and then click the alerts button so that whenever I upload a new video, then you'll be informed of that upload and you won't miss it. So once again, thanks for watching and we'll see you on the next one.